Is this market going to come crashing down, or is it going to climb the wall of worry? How will the markets react to the personal consumption expenditures, that's a mouthful, or PCE report that came out this past Friday when the markets were closed for Good Friday? Well, let's take a look at the PCE data to see what we can see. So normally I like to graph time-based data on a semi-log chart where the y-axis, this axis right here, is in some sort of a logarithmic format. But since the PCE over this time period is covering such a small range, it's okay to look at it on a linear axis. So that's what we're doing here. So with all of that as a preface, let's go back to the PCE and take a look at what's happened in recent history. Now, this data does not go past December. It goes right up to December. So I don't have the most recent data, but we'll look at the increases between this last data point and here, and you'll see that the increases have been fairly moderate. But for right now, let's take a look at what happened over time with PCE. So back in the pandemic, we had a decline in the PCE, decline in prices. There was a lot of inventory and a lot of retailers and other folks dumped it and sold it cheap to get rid of it because they had too much and they were afraid demand was going to drop through the floor. Why? Because unemployment went to 15% or some crazy number like that. It was a huge spike. So there was a lot of fear in the market. Then what happened was, as inventory sold off and demand increased, you can see the PCE started to increase again. And as time went on and people wanted to move out of the city and they started buying houses and buying cars because they didn't have cars in the city, you can see what happened to the PCE here. It increased even more. And then as time went on some more and people started getting back out and doing things, you can see what happened. The PCE slope increased even more. Now, what happened back in, let's call it June of 2022, things started to finally slow down and moderate. And let's take a look at that. Well, prices started to moderate again. You can see that here. And then what's happening now, or more recently? Well, you can see what's happened is there's another knee here, and I kind of screwed that up. And the PCE has kind of flattened out here. Now, this only goes up to December, and I know this last data point is in December. So let's take a look at what the PCE has done since then. So here we are on the website, the government website, where they publish the Personal Consumption Expenditures Price Index. Wow, that's a mouthful. The Personal Consumption Expenditures Price Index. And you can see that, yes, it went up a little bit in November, went up a little bit in December of 2023, but it's actually been fairly moderate in January and February, up 2.4 and 2.5%. These are not huge increases like we saw back right after the beginning of the pandemic. So with all that being said, let's take a look at the wall of worry and what the charts and metrics might be telling us right now. So if we look at the markets back over the past 5 days, now the markets closed not on Friday, but on Thursday because Friday was Good Friday and the markets were closed. But you can see we've had kind of a struggling market here. It was kind of flat to slightly up. And yeah, small caps and ARK were doing better back here. The NASDAQ was kind of struggling. So it's kind of a mixed bag here. Nothing really great to look at. And if we take a look back over the past month, well, you can see again, there's a lot of struggle here. Now, the NASDAQ again is not doing as well as it could be. The Dow is here. Small caps are starting to perform over the last month, and the S&P is doing well as well. But ARK Invest is just floundering. So this is not a stellar looking picture of healthy risk appetite. And what if we look at year to date? Well, if we look at year to date, again, a similar picture. I like the fact that the NASDAQ is up here with the S&P. Small caps and the Dow are kind of neck and neck. But again, ARK Invest has just been kind of wallowing. And then if we look back over the past year, you can see we've had a very healthy risk appetite in general. But again, ARK, the most risky stocks in here, and small caps for that matter, are lagging behind some of the others. Now, if we take a look at a 5-year time frame to give ourselves some real perspective, you can see that NASDAQ is on top. ARK has just been floundering to slightly up, and small caps have also been floundering. So I think these two, if we continue higher, these two have a lot of room to run to the upside. And what if we look at the bottom dynamics? Well, the bottom dynamics have been really acting kind of weird lately. You can see they've been very jagged. We had a bottom confirmation signal that was hanging out up here while the S&P continued to move higher. It pulled back here, and now it's shot up, and it's at 100%. And the confidence level is moving higher. So if this confidence level was up here near 100%, I'd say we've seen the worst of it. That's kind of what I call a bottom confirmation, even though there really wasn't a well-defined bottom anywhere here. But what this is telling me going forward is with this at 100% and this moving higher, it's likely that we may go higher next week. And if you overlay a slope here on the first sort of half of this chart, this is the S&P 500, you can see we had a fairly nice upward move here, but then recently, it's a little tough to see, it's because it's subtle, but if I overlay this slope, you can see that this slope is higher and this slope is a little more flat. So the markets are tentative for sure. That's what this is indicating. And you can see that here in risk versus opportunity. You can see that the risk acceleration pulled back. I was really happy about that, but then it immediately turned around and started heading higher, as I'm pretty sure I said in my last video that it could do that, and that's in fact what it's doing. And to make matters worse, the opportunity level is falling, so this is not good. And risk, which is a very laggy indicator, is rising. So I'm not liking what I see here. Even though I just said that based on the bottom dynamics, it looks like we could go higher next week. This market appears to be climbing a wall of worry. Here's the worry. Here's how it's displaying itself, this increasing risk acceleration, and the market is moving higher as this worry continues. So I'm not sure where this is going to go. I don't like this. It's making me edgy. And you'll see some of the other things we look at are giving me a little bit of concern, but not enough to say run for the hills yet. So speaking of that, let's take a look at equity versus safety. So I'm going to jump right into the overlays here because they can help you see what's going on. And you can see what's going on. Small caps did very well back here and then just started to plummet, and they're stuck here in 5th place. Now, the NASDAQ 100, which back here off the chart was in 1st place, has moved steadily lower. Then it tried to rally last week and then moved down again this week. So this is not encouraging, but there is some encouragement here. Let's keep going. Now, I like the fact that cash has pulled back 1 notch, although it still makes me very uncomfortable when cash is anywhere above the middle position here. I'd love to see cash down here, somewhere in the bottom, not up here. So I'm always uncomfortable when I see cash up here in the top half of this table. But what's been happening with the S&P 500 and the Dow Jones Industrial Average? Now, there is still an appetite for risk, but it's safer risk. The Dow are the safest basket of stocks here in this bunch. And you can see that investors have been pouring their money into the Dow and pretty much staying with the S&P 500. Now, small caps have not been dropping, but NASDAQ 100's been dropping. So there is an appetite for equity risk, but I'd really like to see that appetite be in small caps and NASDAQ, not in the Dow and the S&P 500. And I don't like the fact that gold is staying stubbornly in 1st place. So there's some issues here that I really don't like, and maybe this is all part of that wall of worry that I talked about. Now, if we look at safe haven assets, you can see that back here, EDV and gold shot up. That gave me a lot of concern. In fact, we protected our clients' accounts when I saw this happen. But then you can see that while EDV collapsed, gold stayed up here. Cash moved up and then pulled back. And you can see that now, well, let's look back here. So you can see back here, we had a healthy Treasury market, even back here, with EDV ahead of TLT, ahead of cash, intermediate and short duration Treasuries, healthy Treasury market here, and then boom, unhealthy Treasury market, unhealthy Treasury market. So don't like what I'm seeing here with the Treasury markets. I don't know if this is bond investors reacting to fear that the Fed might keep rates where they are or raise rates when they just indicated they plan to lower them. Not sure, but I'd like to see this flip over and have the longer duration Treasuries on the top and the shorter duration and cash down at the bottom. How does all of this show up in the buying and selling pressure? And look at the price movements, by the way, really jagged, wonky, sort of like driving in Tesla's FSD version 11 versus version 12. Now, the only one that's not wonky is the S&P 500. It has much less volatility. But look at what's happening. The buying pressure has been increasing here, even though it's pulled back recently, and it's still well above the selling pressure, the solid orange line. Now, that's for the Dow. And so investors are putting their money in the safer Dow stocks. What about the S&P 500? Well, again, the buying pressure has been on the increase, although it's kind of collapsed lately, but this is a very nice move higher. Now, when we look at the NASDAQ, we also had the buying pressure moving higher here very nicely, but then it really fell off a cliff. So this is a little concerning. And you can see the same thing with ARK Invest. You can see that the buying pressure, this solid gray line, moved very nicely higher here and then collapsed recently. And you can see that the price has been going nowhere to down. Yeah, it's higher than back here, but since here, where it kind of peaked out, it's just been on kind of a slight downward tilt here. Doesn't really look good. What about small caps? Well, small caps have been performing somewhat better. You can see that at least they're higher than they were back here. And you can see that the buying pressure, this solid gray line, has been moving nicely higher and is well above the selling pressure, this solid orange line. Let's take a look at the sector rankings. I'm going to gloss over these sector rankings because they move very, very slowly and they give you an indication of where the market was, not where it's really is or not where it's headed. But you can see the movement here. I like the fact that consumer staples have moved down a notch. I would like to see cash move down. And I would like to see technology higher. Now, Bitcoin and semiconductors have stayed up here. The NASDAQ 100 was here last week, and now it's moved up a notch, so that's encouraging. So maybe there's some hope here. But let's take a look at sector rank acceleration because these move more quickly and kind of give you a sense of where things are headed. Now here, consumer staples have collapsed down to here, but also consumer discretionary has fallen back, so that's not good. Cash has moved up, that's not good. And treasuries are kind of staying pretty much put, and gold is staying put. So not a great picture, but not an awful picture either. So like I said, there seems to be a lot of worry in the way this is distributed. And hopefully, if things work out well, the markets will climb that wall of worry. And what about treasuries? Well, if we look back over the past week, you can see that they collapsed at the beginning, and then they had a very nice rally going into Thursday at the end of the week, the end of the trading week last week. So this is looking like a healthy appetite for treasuries. What if we look back over the past month? Well, you can see it's been up, it's collapsed, and now it's going higher again. So at least over this period, since March 18th, you have a fairly healthy risk appetite for longer duration treasuries, which looks really good. Hopefully this will continue going forward, and we'll take a look at that when we look at the buying and selling pressure for treasuries later. Year to date, you can see an unhealthy appetite for treasury risk. And then if we look back going 1 year, you can see again an unhealthy appetite for treasury risk exposure. Why am I missing one? 20-year treasuries aren't showing up. Interesting. Oh, well. What about 5 years? Are they there? Yeah, so 5 years they're there. So if we take a look over 5 years, you can see we had a big rally back here during the pandemic. And then as interest rates went up, the treasuries collapsed. Now, these long duration treasuries, the Vanguard Extended duration Treasury ETF, they're down 34% from where they were 5 years ago. So I don't think they'll get back to zero. That would mean extremely low interest rates, and I don't think the Fed wants to go there right now. They may be forced to go there, but look, to get back to zero, this thing would have to go up well over 34%. And that would be a huge gain for pretty much a safe haven asset. Now, like I said, I don't think the Fed is going to take rates back to where they were 5 years ago unless they're forced to do it to stave off some kind of a threat. Okay, so what about the buying and selling pressure for Treasuries? Well, if we look at the buying and selling pressure, short duration Treasuries really have kind of gone nowhere. You can see that they dropped, they tried to rally, they pulled back, they rallied again. You can see that in the buying and selling pressure here, a lot of switching places. So no real clear direction at the short end. Intermediate Treasuries, very similar picture. No real clear direction and leadership in the buying and selling pressure, except back here where the buying pressure really peaked in both places. If we go out to intermediate to long duration, very similar picture, flat to nowhere. And then if we look at long duration, very similar picture. There's really no leadership here, except I like the fact that the buying pressure bottomed out back here and is now moving higher. So maybe this indicates a risk appetite for longer duration Treasuries if this continues moving higher and the price continues moving higher. But there's no guarantees that will happen. And what about the inverted yield curve? Well, you can see that not much has changed from current, the dark blue line, and a month ago, the red line. We're kind of right where we were a month ago, and we're way far away from where we were a year ago. Now, the curve has gotten a little more inverted. I think it was about 38 or 36 basis points inverted last week and the week before. Now it's minus 42 basis points inverted. So we've got a long way to go for this to become uninverted. And the way that's going to happen is for these shorter duration rates to come down. And the only way those are going to come down is by the Fed reducing them. That's it. They control that end. They don't control this end. And what about the Fed rate monitoring tool? Well, there's a 90% confidence level that the Fed is going to leave rates exactly where they are in May. And what if we go to June? Well, in June, that confidence level drops by more than half, and there's a more likelihood that the Fed will lower rates by 0.25% by then. And what if we go out to July? So by July, the confidence level increases that there will be at least 0.25% and possibly even 0.5% reduction. If we go out to September, you can see the idea that rates could be where they are right now really drops to insignificant. And more likely that we'll be somewhere in the 0.25% to 0.75% range in dropping rates. And then if we go to November, you can see what's happening. We get out to December. I'm amazed that there's even a bar here in December. And we go out to January, still a bar there. And we go out to, my God, March, and there's still a bar there. April, oh my God. There's still a bar there. There's still a tick there. Where do we have to get to here? June? Nope. There's still just a tick there. July. Oh my God. Yeah, finally July, it falls off. So this is 0.25% lower than where we are. And you can see that this really broadens out. So meaningless. This will change a lot by then, but kind of fun to look at what the markets think as you go out in time.
I feel like I'm afraid.
And what about gold? Well, gold had a spectacular rally here, and then it kind of noodled sideways, and you can see that in the buying pressure, which just collapsed, and it now has been pretty much going sideways and trading places with the selling pressure, this solid orange line. But recently, the price has moved higher, and the buying pressure has moved just a little bit higher. So no idea where this is going. I don't have an idea of what's driving it, but usually this is tied to inflation, which I don't think it is in this case. But maybe there's fear of geopolitical risk and, risks in the world, and we have a presidential election coming up. So I'm not sure what this is about, but I'm pretty sure it's not about inflation.
Of your heart, you can have
And what about Bitcoin? Well, a spectacular rally from quite a ways back here. And then, it's been kind of pulling back and consolidating for a while. You can't keep going up forever. So we'll see what happens. But we had a big peak in the selling pressure here. And by the way, it peaked out before this bottomed out. You can see it dropped here while this was going down, which is kind of a divergence. And then it started moving higher again. Now the buying pressure bottomed out here and started moving higher. But recently it traded places with the selling pressure. So this is going to take a while to play out. This could go on for months where it goes sideways to nowhere. To be an investor, you have to take the long view. You've heard me say that many times. And you have to stay the course through all the ups, downs, and volatility of returns. As you can see in these graphs produced by Brian Feroldi, and hopefully I didn't bastardize his name, on his X account, link in the pinned comments below. But if you look at these, he kind of says it all right here. Saving is like this. Investing is like this. And I think he's got some really great graphs here for kind of explaining investments. Although any of you who have watched my previous videos and my videos about portfolio construction will know that I agree with this side of the barbell. I totally disagree with this side. 100% stocks is not the best way to go. You actually get better returns by having a better balance of stocks and U.S. government treasuries because of the nonlinear effect that most people don't know about. So maybe someday I'll be able to have a conversation with Brian about that aspect of investing. But you can see he's got some great information here, I love this one because it's so true. You get to $20 and you cheer, and then when it keeps going to 30 and you're happy, and then you're back to the same 20 and you're beating your head against your desk. So yeah, I've seen that many times. But there's another graph in here that I really want to show you. If I can find it. Here's a graph of Brian's that I really, really like because I've been managing money for investors for a long time, and their expectation is this. They want to see exponential growth forever. And the reality is, this is how you get there. And it's very hard for people when they're experiencing one of these moments. It's easy when they're experiencing these moments. So this is a great graph that explains the difference between what investors would like and what the reality is. And the sooner you come to grips with, you have to take the long view and deal with the ups and downs while you're getting to this point, the better off you'll be as an investor. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media. With their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips, but the sun's stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running down, trying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold-proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water. Wet my lips, but the sun is stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? Throw it all away, we could find that time to block out all the bells now and make it right. No, wait, gotta change what's mine, gotta bleach my hair, try my pain